I have the pleasure to moderate the seminar about the strategic players and the evolving M&A approach. Why is that very relevant for anybody? One thing we've learned over time is that at any life stage for an emerging brand, at the beginning, before founding it, to getting the first funding in from angel investors, to possibly finding some growth funds or some strategic investors, at any given state, it's the funding decision that makes a big decision, or requires a big decision by the founders. And it's driven always by thinking about what the strategics want or what the strategics would do. So while some found a company with the intention to maybe build the next Bacardi or the next Tito's, a lot of them would say, we need to know what's happening in the environment to make sure that nobody overpays, nobody thinks about that the price is smaller than what people think. So what's happening? And it's all driven based on what the strategics doing. And we thought it would be very valuable to hear from them directly. We thought we would have Nick Moody from Royal Bank of Canada to start off. He's an analyst who follows the industry. He follows the strategics and what they do, to give us some background with regards to what the big players are doing from the Wall Street perspective. And please join me in welcoming Nick Moody. Thanks.
Thanks. What I wanted to do is just talk about some themes and trends that are going on in the industry that have a bearing on how the strategics, or how you should think about M&A. So, just kind of listing these down really fast. Across CPG generally, spirits has, the superior growth. I mean, you can see here dramatic difference between, and I cover everything. So I follow food companies, I follow beverage companies, tobacco, beauty, household personal care, and you can see that the spirits industry has very superior growth. The second thing is, when you think about big M&A, there's not a lot that can still be done. I mean, there's a scarcity of publicly traded assets out there, especially when you think about some of the other subsectors I follow, like food or household personal care. The spirits industry is levered to, I think, one of the most dramatic themes and trends out there that I think will persist for quite some time in an economic downturn or an upturn, and we can talk about that in Q&A if you're interested. But trade up, I think trade up is structural. I think it's psychographic, and the spirits industry is very levered to that very important trend. Valuations are near high, so you can see here, looking across some of the big strategics, the 10-year average PE, then the kind of the forward PE, and you can see here that the average relative to the 10-year is significantly higher, right? So we're operating in an environment where a lot of these valuations are above where they have historically been. Now, part of that is interest rate driven, okay? So when you think about publicly traded stocks and interest rates as low as they are, that's partly driving. But the other thing that's driving it is superior top line, which we talked about earlier. Another point is what I call the 3G philosophy avoidance has paid off. So when you think about the general consumer products goods industry, generally speaking, many of the companies have been cutting costs as they try to mirror 3G in terms of how to create value. Cut costs, improve margins. That worked for about 2 years. The spirits industry has actually avoided that trend, broadly speaking. So what I did here is I looked at Kraft Heinz as an example, okay, who's owned by 3G versus the spirits average, and this is selling and marketing expenses as a percentage of sales, and you can see the trend. Look what's happened to the Kraft Heinz coming down, whereas the spirits industry, broadly speaking, has gone higher, and that has helped support a very healthy top line. The next point, okay, is and obviously we have two very important people to talk about this theme, is big spirits companies are creating venture arms, right? So what we're seeing is deals being done at very, very early stages, and that's becoming a more frequent phenomenon. A couple other deals, thoughts to talk about. Big deals are being issued by investors. When Constellation announced their Canopy stake, the stock took a nosedive. It actually hasn't recovered since, but we can see that in other industries as well, where big deals are really not looked favorably. So that's why a lot of these bigger companies are looking at smaller bolt-on deals as a way to create value. Big companies not only buying smaller assets, but they're also getting rid of brands. So you think about Diageo and its asset sale, Constellation and this asset sale and Brown-Forman. And the interesting thing here is a lot of these brands that are being divested are not in the premium tier of the segment. So you can see that companies are really taking this trade-up phenomenon, and I think many of them view it as structural. They wouldn't be making portfolio changes like they are right now. Focus on craft and suppliers in the very early stages of development. We talked about that. Craft distilleries right now numbering in excess of 1,300, growing at a 40% clip over the last few years. So, you know, this is going to be a trend that's going to be around for quite some time. Last 2 points on just big picture trends and themes. The spirits industry is positioned well in what I call today's narrative-based brand building environment. It is no longer the companies telling you why you should buy their brand and drowning out the competition and you buying their product. That's how P&G built their empire. That's how Kellogg's and General Mills built their empire. Today, it's all about your trusted network and the narrative, right? The story behind the product, right? And the spirits industry is really levered to that when you think about the rich histories of some of these brands and the process in which these brands are made or these products are made and the narrative that can be told. They are very social media friendly. We see this in wine. We see this in beer. We see this obviously in the spirits market with bourbon, tequila, and scotch. And the last point is distributor consolidation, making it even more important to have scale, right? So it's tough these days as a small brand to get some of that mind share from the distributor, which being part of a larger organization could be advantageous. So just real recent M&A activity in spirits, and I thought I'd just list some of the most recent things down, and you can see kind of the reasoning, right? So Constellation and their recent deals, you know, growing their craft spirits business through their venture arm. Pernod enhancing their portfolio of super premium gin, and you can go down the list. But I think the most common theme there is A, companies getting into subsegments for the first time, or B, really getting some of these smaller local brands into their portfolio with the hopes of building them into the next mega brand in the future. Here's the thing, right, is that obviously if you think about some of the biggest categories and you think about how fragmented those segments still are, I mean, so there's a lot of opportunity to consolidate and to acquire and to consolidate either through own brand building or consolidate through acquisition. So you think about the top 5 brands in vodka, whiskey being about 34, 35%, and the all others. I mean, that's big. I cover, again, probably 270 different categories from diapers to scotch, okay? And I can tell you that the brand fragmentation in this industry is one of the highest I've seen. It's actually more fragmented than the prestige beauty market, which is incredibly fragmented. And you think about all the new brands coming out in prestige beauty. So this is, you know, when the big strategics kind of look at the level playing field, it's like kid in the candy store. There's tons of opportunity out there for them. So there's a lot of competition. Okay, one last point. Next slide. We're talking about craft spirits or spirits, right? The reality is that's not the way we can think anymore. You know, it used to be you versus, oh, okay, beer and wine and spirits. Like I hear this all the time. I go to every conference out there and it's like, oh, I'm at a beer conference. They said, oh, you know, wine and spirits are taking share. And I'm at a spirits conference. Like, we're taking share from beer. And the wine conference, we're taking share from beer too. I mean, poor beer. Next slide. But the reality is everything is converging. We need to start reorienting our minds from an M&A perspective, from a brand building perspective, from a strategic perspective, away from categories and towards occasions, because everything is starting to converge. So think about it. Is this soda or water? Right? We have a lot of sparkling seltzer and flavored sparkling waters. What is it? Is it a soda? Some of these brand products have the same sweeteners as Diet Coke. Is this coffee or water? Is this beer or spirit? Is this wine, beer, or weed? And my favorite, is this cannabis or pain relief or dessert? But the point being, the point being is product categories are converging, and consumers are now starting to think about things in relation to occasion and function versus category. So I'll stop there and pass it on to Nick. Oh, pass it on to Harry. Sorry.
All right. Thanks, Nick.
I'm Nick Papanicolaou, and I am the VP of Business Development at New Brand Ventures, which is a subsidiary of Pernod Ricard. Just as quick background, Ubrand Ventures is kind of a hybrid of an internal incubator where we take some of our own brands that we think have potential but had never really been given the love and care to succeed and to scale. And the other component of it is working with external entrepreneurial-led brands to bring them in through minority or majority partnerships and help them unlock value. So the theme of today is about the changing M&A landscape, and in particular how strategics look differently at M&A. So I focused my topic a little bit about, in this evolving, changing landscape that Nick referred to earlier, there is increasingly the need for brands to break through. And I'm not talking about just from a financial perspective, I'm talking about from a differentiation perspective, from a brand perspective. Are you filling a need in the market that actually exists? So yes, suppliers are obviously eager to invest. If you look at what's driving growth in this industry, we say about 60% of it comes from innovation, and innovation is broken into two things. Line extension innovation, which I feel like a lot of people in the audience might not actually classify as true innovation, but that's about 30% of the growth. And then the other 25 to 30% is new to world innovation, which is what many of you probably in the audience are doing. So innovation is driven largely or in large part by new and emerging brands like yourselves. The graph on the left here, this is actually credit to the Craft Spirits Project and Harry and Park Street for some of the work that went into this, but you can see that the case volume of craft spirits producers has been growing at about 25% a year over the last 5 years. I don't think on the right side of that left graph, I don't think that's Park Street's actual projections. I think that's just different scenario analysis, but it's pretty remarkable to see that the industry is probably going to grow another 2 to 3 times over the next 5 years. So clearly this is of interest to us and a big driver of returns. On the right, I think this is a fantastic graph, another ripoff. I didn't do any work on this page. This is from ADI and Copper Sea Distilling. And I think it's to show a quick kind of analogy to the craft beer space. I'm not going to comment whether I think spirits is going to exceed or be below what craft beer is, but just as a corollary, you can see that craft beer has been on roughly a 30 to 40 year super cycle and still growing, although softening. And craft spirits is probably 10 to 15 years into that. So we're definitely less than halfway, if you believe this story, maybe a third of the way through that growth cycle. So we're definitely excited about this. Now, in that changing landscape, what's interesting is that, quite frankly, the number of targets breaking through is becoming fewer and fewer. This page we did create. So the graph on the left is from Nielsen data. It's certainly not all-encompassing for the market, but what you can see is that what we would classify as potential breakthrough brands is about 10 to 15% of the total market. So we think about 10 to 15% of the brands out there have the potential to be breakout stars, purely from a size scalability perspective. Now what you actually see is on the graph on the right, you see fewer and fewer of those brands are actually breaking through. So this is now brands that were below the 15,000 case mark, I think it was below 5,000 or 10,000 cases, that have broken above 15,000 cases within 3 years. So that number has decreased by more than half, from almost 6% in 2010 to brands in 2015 that 3 years later, meaning 2018, have broken through that 15,000 case threshold, is declining pretty dramatically. What does that mean? So this page, by the way, I had some valuation metrics on, but I generally don't like to put them because I think it anchors the audience perhaps on the wrong message. So a lot of these, so what does this mean? This means that the brands that are breaking through are going to attract a lot of interest from strategics, and probably they're going to demand above market valuations or multiples. I'm sure you've heard of some of the valuations for some of these brands, so again, it's not worth talking about, but the point is they are breaking through and garnering a lot of interest. I also want to caveat this page by saying, for every 5 brands like this that break through and demand a 17 to 20x revenue multiple in Casamigos' case, there are hundreds, if not thousands, of brands that are not getting deals done or that are getting deals done at much lower multiples. So again, point of this is just to say brands are breaking through and it's garnering a lot of interest from the strategics. So what does that mean? Well, for us, there are kind of 2 ways now that we look at an ability for brands to break through. One is from a brand building perspective, this page. The next page is on business models and kind of new delivery channels. So I'll walk you through. This is kind of 6 criteria we look at from a brand building perspective, with ultimately the goal that we think consumer centricity is key. I've talked in the past on another panel where I actually said that I think launching a brand, by the way, I myself launched a brand, so this is not a criticism of everyone out there by any means, but when I launched it was actually rather an egotistical move if you think about it. I had this idea in my head where I said, I have this great idea, everybody's going to come, it's a build it and they will come mentality. And I think that model is broken, that doesn't work, and you need to be consumer focused. You need to be really understanding what the market need is, and then hopefully kind of testing and iterating and improving your proposition based on market feedback. But really quickly, I'll go through each 6. So the first, energy. So does the brand have energy? Is it something that we need to keep spending money to continue to get the word out, or will there be some kind of virality based on the energy that's around that proposition? Voice. Is there a tone of voice that's kind of authentic and clear? Does that tone of voice have energy as well? Tangibility. So to me, this means, are you rooted in some kind of brand purpose that's very lofty and idealistic, very meta? Or is it something tangible that a salesperson can say, I know how to take that and convert that to POS or to messaging or to last 3 feet materials? Differentiation, this is your typical USP. Again, are you differentiated enough in market? But we also look at, are you differentiated enough, of course, in our portfolio, in our distributors' portfolio, and in the retailers, some of the large retailers that we tend to work with. Relevancy, so this is, you can have a fantastic brand purpose and emotional connection, but if it's not culturally relevant today, if this is a theme of 50 years ago, who cares? It has to be culturally relevant today, and we have to be able to see that for the foreseeable future, that is on trend. And then lastly, alignment. Is everything in your marketing ecosystem aligned? When you talk about your brand purpose, you can see a lot of the things I'm talking about today are not related to product functional benefits or rational benefits. It's around emotional benefits. So how does this align in your ecosystem? Your brand purpose, does it resonate in your social media, in your sales materials, in your POS, etc.? So that's on the brand building side. On the new business models, quite frankly, this might be a little bit of a stretch to say these are all new business models, but I think they are kind of alternative ways to, and alternative channels to grow your brand that we've seen some new brands increasingly do. So off-premise, just very simply, I think the traditional model of build it in the on-premise with the trade and people will learn about it and then they'll go to the off-premise to buy it. I think that, not that that's broken, but there's so much money and so many brands going towards that we like to see occasionally brands say, you know what, I'm going to do it in a different way, and the off-premise is a certainly viable and more cost-efficient way to do that. Locality and regionality, I think the days of national breakout brands are probably behind us, or certainly fewer and further between now. We'd probably rather string together a group, much like the ABI strategy, stringing together a bunch of regional successes. So maybe it's a New England spirit that has 40% market share in New England, rather than that same spirit going to all 50 states getting 2% market share. Then you've probably all been hearing about this idea of non-premise as kind of a replacement to on-premise. It's in Mark Brown kind of every other week here. I think that's really interesting. We've seen a lot of brands say, again, screw the traditional model. I'm going to go to festivals, to music conferences, to music events, things like that, and really try to generate kind of a new audience that they wouldn't get through the traditional channels. The visitor center model we think is very interesting, and I know a lot of you out there do as well. Obviously, one of the clear benefits of this is getting higher margins, higher profitability. But I think the flip side of that is the scalability is pretty limited. What we've seen a few smart brands do is actually say, how can we open multiple visitor centers, bars, tasting rooms, either across states or, depending on state regulation, even within the same state. And then finally, direct to consumer is a new business model. This is definitely a misused word because I don't really think direct to consumer actually legally exists other than at your own facility or tasting room. But having said that, I think using some of the e-commerce players out there, the mini bars, Drizzlies of the world, is a fantastic way to kind of gather data, to be super hyper-focused on your tribe, gather data, and then iterate messaging and proposition based on that. So that's the last slide for me. I just want to kind of summarize that I think, the way we're looking at it, there's clearly an evolving landscape, as Nick mentioned. There's distributor consolidation happening. More and more brands coming to market, so you're kind of hit with on two sides of it. More brands coming to market and a bigger bottleneck to get through. And what's really resonating to us is brands that can figure out how to break through in that changing environment. The two biggest ways that we see are from a salient brand proposition and from unique or alternative business models or delivery channels. Thanks, everybody.
Let me now please introduce to you Jennifer Evans. Jennifer is the VP for Constellation Ventures. And Constellation, obviously, with a lot of different M&A activity over the last couple of years. Jennifer has a perspective of having worked at Constellation a lot of different ways. And she took over the venture business last year. And please welcome with me Jennifer Evans.
Thank you. Thanks. It's nice to see all of you. Thanks for coming today. What I thought I'd do is just share a little bit about Constellation Ventures, what we do, how we think about investments, and how our investment philosophy has been changing. So you can see our portfolio, our model. We are a minority strategic investor, which means we provide capital, but we also really partner with our portfolio companies. So we meet with them, we figure out where they are in their life cycle, and it'll be everything from developing really detailed commercial plans to brand strategy, brand positioning, package redesign, route to market, figuring out which markets they should expand into, and prioritization. So we really do partner with our companies. It's between us and them to drive their businesses forward. And so last year, we announced an increased focus on female-founded and female-led businesses. So we pledged to invest $100 million in female-led and female-founded businesses over the next 10 years. We've gotten a really great response from that. And I was asked to talk a little bit today about why we did that, why we think that's an important thing to do. So just to set the stage, you can see over the last 10 years, the landscape has changed pretty dramatically. In the 70s, there were just under 9 million independently owned businesses in the US. Less than 5% of them were owned by women. Fast forward to last year, there are just over 30 million businesses, independently owned businesses in the US, 40% of which are owned by women. So now, not only have you seen just a tremendous explosion in independently owned businesses, but 4 out of 10 are owned by women. So it's a huge, huge opportunity. And on the next slide, if you look at how they're performing, you actually see that women-owned businesses are performing exceptionally well. So this, on the left-hand side, you can see over the last 10 years, these are companies that have generated over $1 million in revenue. For the women-owned businesses that are generating $1 million or more in revenue, they've grown by 46% versus the general number of companies in that field that have grown by 12%. In terms of employment rate, women-owned businesses in this category have increased employment by 30% over the last 10 years versus actually overall it's slightly negative. And then finally, if you look at just absolute revenue generation, women-owned businesses have increased absolute revenue generated by 45% over the last 10 years. So not only has the number of women-owned businesses just skyrocketed, they're doing extremely well. But what we found is just 2% of women-owned businesses receive just 2% of the venture capital that's out there today. But studies do show that they generate more than 2 times the revenue per dollar invested. So a huge opportunity, and one that you can't ignore. So at Constellation Ventures, we do have an increased focus on finding really incredible female-founded businesses to invest in. And so I thought then, just broadly speaking, I would just back up and talk about our portfolio in general and how we think about female and non-female-led businesses. What we're looking for in terms of investments we make, we are looking for large market opportunities. We're looking for brands that can really scale beyond their home markets. We're looking for brands that are differentiated. You know, we talked a little bit about this on the panel. There are so many brands out there these days, and so it really has to be a brand that is truly differentiated, truly unique. There needs to be exceptional quality. That is table stakes, just fantastic liquid, great packaging. There needs to be clear consumer pull. We get a lot of founders coming to us with fantastic ideas, but it's just so early. We really want to see time in market to show that there's sustained consumer demand for that brand. We're looking for outstanding management. And of course, this is again table stakes, but you know, you cannot underestimate how important it is to have a management team that has the vision and the ability to really drive their brand and achieve the objectives they've set out. And it's not on here, but included and embedded in this is also fit. And this is very subjective. I think finding an investor and a portfolio company relationship where the fit between both parties works, that's so incredibly important because it is a partnership. And then finally, fit within Constellation portfolio. You know, similar to some of the comments that have been said, we're looking for brands that can really augment Constellation's portfolio at large. So Nelson's Greenbrier is a great example of how our strategy comes to life. So we invested in Nelson's about 3 years ago. It's a fantastic distillery down in Tennessee. And over the years, the last 3 years, we've partnered with them, really started to grow the brand. We see a lot of potential. And then very recently, we announced that we increased our minority stake into a majority stake. So just kind of an example of how brands can move through our process. And then finally, I thought I would wrap up on the last slide with just some pointers from my perspective of what's really critical when you come to pitch. Every pitch is different, and it should be because they are individual founders that are pitching them. But in my mind, I think you do have to have these 4 elements. So the first is really knowing your category. A lot of folks come with a really good sense of their brand and their story, but not really a good holistic view of the category in which they're playing. So really understanding what's going on with consumers in that category, who the competitors are, large and small, what they're doing, and then how you and your brand fit within that. It's knowing your story, which is, again, what makes you different and differentiated in this entire sea, very, very crowded ocean. It's knowing your audience. You know, investors are looking for very different things. So if you're talking to a strategic, knowing what their portfolio looks like, knowing what their broader portfolio looks like, and also who they've invested in historically, to really see where you would fit in and how you can pitch yourself into fitting that audience. And then finally, it's having a plan, which sounds really simple, but I see a lot of pitches that show companies tripling their business for 10 years in a row. And you know, that does actually hurt your credibility if there isn't a clear plan there. So what I like to see, I do see businesses that say, you know, I'm going to grow by X% every year. Here's how I'm going to do it. Here are the markets I'm in today. Here are the markets I'm going to expand into. Here's how I'm going to activate this. That goes a long way to establish credibility and make the investor feel like it could be a good investment. So that's what I got.
Great. Thanks so much, Jen. All right. Thank you so much, guys. So I'm going to kick it off with questions, and then I'm going to open it up for the audience for additional questions. One question is, Nick, when you had Moody now, when you had the chart up there with regards to the white spaces of the different players, and you mentioned that some of the white spaces might not be really white spaces because there might be dark space. I think then Nick said, like, oh yeah, we have actually nothing to do. So how do you define, I mean, for both of you, Nick and Jen, a white space for you? So when you did a gin play recently, and you do have a gin, but that was maybe a different view. So if you guys can talk a little bit about like how is a real white space other than just a category white space?
Sure, yeah. You want me to kick off? Well, just since you mentioned the gin, I'll talk quickly of Malfi gin, but look, the reality, first thing I'll say is we are a global company. So we have new brand ventures operating in the U.S. Our focus is to find U.S. growth stars. Malfi Gin is 10 to 15% of their businesses in the U.S. It's still a huge potential for us. But that was an acquisition more considered from the global perspective out of the UK and Paris. Having said that, we do believe it's a white space. And if you look at what's in New Brand Ventures portfolio, we have Monkey 47 at an extremely high price point. And then we have Plymouth Gin around the $30 to $35 price point, so a little bit competitive from a price point perspective to Malfy. But from a white space perspective, we look at the two brands we have, Monkey and Plymouth, as very, very trade-oriented. Plymouth is at a 20-plus year really embedding themselves in the trade, and Monkey 47, 7, 8, 9 years or so doing that. I think when you look at Malfy, and that's one of the things that attracted us to it, was that the white space really was on the consumer end. You look at what they're doing from a consumer perspective on digital and social media. I mean, that is like one of the most Instagrammable brands I've seen with the colors and how vibrant they are. So we thought that was kind of the white space that can fit into our gin portfolio. At some point, obviously, it becomes too saturated. We are now 8 brands, and 3 of them are gins in the NBV portfolio. So I don't think that there'll be a huge push for us to be looking at another gin. But again, we are a global company, and this can exist where there's a need in another market. And if there are ways we can tap into some of our resources in the U.S., we still could take it into new brand ventures.
Got it. Jen?
Yeah, I would say, so we start very simply category and price point, but then you overlay positioning. You look at geographic reach. So you might have, especially with craft spirits, a really strong focus in the Pacific Northwest, for example. So, I think you have to look at, it's not as simple as just category and price point. It's about positioning, it's about regionality, and then, where you think you can scale it.
Got it. Interesting. From a perspective of the integration, I think at one point you mentioned that you increased your stake from a minority investment to a majority investment. What drives the decision with regards to the integration? So when you provide strategic benefits of the mothership to the individual venture, when does the decision is being made, or what drives that decision?
Yeah, I mean, there's not one single answer, so it does vary by the brand. I think you're looking for when it's just starting to reach that tipping point, when it can start to benefit from more of the mothership power to just, really get it to take off. So it's more of an art than a science, but it's all about seeing that it's gone really past that regional play, and it has the legs to just take off.
Got it. Now, Nick, your perspective, is there like a guideline you guys have, or is it similar?
No, it's very similar. I will say, look, one learning we had from our experience with Avion, which was before New Brand Ventures, but that was a minority investment initially that went to majority and then went to full buyout. And honestly, from our perspective, we found that a little bit confusing because it's hard to, those decision rights and things can get a little blurred in that middle period. So we prefer a two-stage process, either minority to eventual full buyout or majority to full buyout. So knowing when to integrate, I completely agree with what Jennifer said. It's definitely more of an art than a science. I think we look at exactly when that kind of tipping point is where we can say that entrepreneurial model, I'll use the words maxed out, but I realize, Tito's might object to me on that, but I think there's a point where a lot of entrepreneurs will say to us, I can bring it so far with your support and certain plugins that we'll need from the large corporate system, but at some point, I think I've probably maxed out what I can do, and vice versa. We're sitting there saying, we're probably not really good at that early stage of what you guys are doing, being agile and kind of nimble and more creative and disruptive, but at a certain point, we can bring in our own muscle and our own route to market and distribution power. So there's not a benchmark where we say, oh, it's right now. It's kind of a period where you start to see the signs and know it's about time for us to really kickstart this.
Got it. One additional question on valuation. I know that you said it's like, look, we don't really want to put this on a chart, and I completely get it. It's like there's a thing, you negotiate with somebody, you don't want to tell them, hey, this should be your expectations. Now, I don't want to actually ask you guys a question. I want to actually ask Nick, because you are like the one that sits on the sidelines at times.
Yeah.
What are avenues for all of the entrepreneurs out there to figure out what the real valuations are? Because for publicly traded companies, they do have to make disclosures at times. They can't just spend money on things without disclosing to their shareholders. So what are the tips and tricks to figure out what the right metrics are to
Thank God you're asking Nick, because last time I completely avoided your question.
So I'm in the market selling a spirits brand, so I don't know if I can. No, I'm just kidding. Look, I deal with the situation a lot in terms of IPOs and things like that, but there's not a lot of history, and so you have to place a valuation on the business. The simple answer is not simple, right? The reality is you have to do a cash flow analysis to really understand what you're worth, and that's really the only way to do it. And we're in an environment where that's an accepted form of price discovery because there's so many new businesses, unicorns and what have you, Uber, right, trying to go public. So we actually do have a really robust methodology out there that people use. That's the true answer on how to do it. The reality is you think about what Jennifer was saying about when you go into pitch and you have to provide like some evidence of why you think you're going to continue to grow. That has to be part of the valuation discussion. That can go into the cash flow model too. So if you think about the pitch, right, the post, Park Street University pitch, right? Yeah. It's hey, this is what we think we're worth because these are the plans we have and these are the markets we're going to get into. To me, that like if I was sitting across the table assessing an initial public offering of a publicly traded company, that's exactly what would resonate with me, and I'm sure that's exactly what would resonate with the two on the side of me as well. So I think that's probably the most direct answer I can give.
So now if we go on the opposite side of the timeline, so this is the exit, and this is a question for both of you guys right now. Mm-hmm. If somebody goes out for the first round or for raising the first money, there is no, you come up, you don't have a track record, you can't say it's like, oh yeah, we want to grow 3 times because there's nothing from before, so therefore 3 times is nothing. So you have a complete uncertainty. What's the valuation that somebody should come out with when they try to raise the first money?
I'm happy to jump in. So yeah, again, a difficult question to answer, but I would say, and I'm putting on my own entrepreneurial hat here, if I were in your shoes, I would really look at kind of replacement, what I would call replacement costs. So in other words, what did it take that entrepreneur to get to that stage? And that could have nothing to do with actual sales metrics. It could be entirely based on the balance sheet. In fact, just as a quick side note, I've seen situations where if you use a traditional sales metric, let's say it's 5 times revenue, revenue's $1 million, values the early stage company at $5 million, but maybe they've been laying down an aged spirit for 4, 5, 6 years, and the value of that inventory is in excess of the $5 million valuation. Yeah. You can't use a traditional, even sales metric, which is what most of the entrepreneurs tend to use. So DCFs, discounted cash flows, those are hard, if not impossible, to use for early stage companies. Yeah. And I think the traditional kind of sales metrics are useful, but can be difficult. So I'd be looking at it as, what would it cost us, Pernod Ricard, to actually recreate the brand that you guys have created from an asset perspective, from a building relationships with customers and distributors, and you start to factor all of those, which are very hard to value. How do you value a customer relationship? But I think looking at it from that perspective, how would we create that brand is probably the best useful metric, I would say.
Yeah, we do start with the typical sales multiple. Sometimes we'll look at GP multiple. DCFs are very common. You make the best assumptions you can, and you, again, back to the partnership, our philosophy, we do partner with our prospective investments to make sure that, assumptions make sense on both sides. And, you do this for a little bit and you start to gain a feel for it. So there's a little bit, again, of the art in there. I will say another thing back to the pitch piece. Folks, when they come in sort of waving around Casamigos multiples, don't do that. It's not a good look. So
it goes back to your point about credibility. Correct. On whatever you said, 30% growth, 300% growth for several years or whatever. It's if you come in with that, you do tend to lose a little bit of credibility because that's not the reality.
Now, what do we do if George Clooney walks to the door?
George Clooney can do that.
Now, a question vis-a-vis the process. Do you prefer if somebody has an advisor that comes in that basically runs the process that sends you a standardized deck, or is it better to have to have a personal discussion without a professional there that tries to guide the discussion?
It depends. I'm open to either form. I think when they don't have an advisor, there are chances that the pitch is a lot less buttoned up. They haven't thought through all of those elements. And I will say you don't get a second chance to make a first impression. So I would say it's not bad at all to come without an investor and to have those dialogues. But if you're, you got to make sure you're buttoned up and you have all of the elements together. We do meet with folks who are just too early for us to get involved, but that's okay as long as, first of all, you're not desperate for cash, and if we don't invest, that's it, because that's just, that's not a great place for the brand to be. But, we are very open to keeping in touch with folks, so perhaps it is too early to engage an advisor. That doesn't mean you shouldn't reach out.
Can you put a figure on what too early is?
I generally don't put a figure on that. Again, I think it's back to showing that sustained consumer pull, because a lot of folks can have explosive growth in the early days because it's nothing but growth. It's off of an N of 1. So sorry to be vague, but yeah, it's really just showing that you've been in market. You've got sustained pull. Perhaps you've expanded into other markets that show that it's not just a home field advantage.
Are there any situations where you would make an investment pre-revenue?
Not.
I mean, no situation. Like let's say George Clooney walks away and comes up with this new venture.
Right.
Would that be a situation, or is there something where you could envision it, or it's kind of like, no, it's just outside of the criteria, therefore, no?
You never say never, but that would be it would have to be a pretty extraordinary situation for us.
Yeah, for us, we actually have it's quite a high benchmark, but we have a 10,000 9-liter case threshold before we invest in a brand. Now, we recognize that is very high, and we are trying to figure out ways to bring that down. But again, the question kind of becomes, if you're going so early stage, then does it make sense to incorporate in the route to market? I would even argue as a strategic guy that I'm not sure it does, because you're going to get lost in the system. So then what value add are you providing? Jennifer talked about some of them. I do believe those are ways you can add value, but for us it's kind of a decision of we'd rather crowdsource from the market kind of the brands that have really broken through, and then yes, add resources throughout and eventually put it fully into our system. But in the short term, we don't think that makes sense.
Harry, can I just interject? Sure. And maybe going back to my convergence topic. So what I'm finding we're talking about there's a small number of strategics and a lot of, small emerging brands. Well, what I'm finding across my overall coverage, the Cokes and Pepsis, and even I was with Monster recently, and they talked about getting into beverage alcohol, the right opportunity presented itself. So what I find interesting is that strategics, just like we have to redefine the category to the occasion, we might need to redefine strategic too, in the grand scheme of things. Because I do think there's going to be broader interest from other non-traditional players looking in the space as well.
Very interesting.
Yeah, I think that's absolutely true. You're seeing more strategics add components of financial investors going minority and more passive, or a blend of passive and strategic value add, and you're also seeing more financial players adding resources or quote-unquote strategic value as well. So I think there's absolutely a convergence there. Can I mention just one other point, going back to the question about bringing in a banker or a broker? I definitely agree with you, Jennifer, by the way, that if you're not buttoned up, it's going to reflect poorly on you, and there'll be creating too many questions rather than answers. So we tend to want to obviously see a buttoned up presentation and due diligence package. Having said that, and I'm speaking almost more from a financial player's perspective, I think you're going to find a lot of them probably are going to be saying, but if there's a 3%, 6% fee built in based on that placement agent, that already becomes some dilution to the returns on investment. So I think financial players, probably more so than strategic players, will be saying, if there's no real value add, if you can create that presentation and due diligence yourself, I'm not sure we'd want it. Having said that, again, they do add a lot of value, I want to be clear, but if you can do a lot of the things that they do, then I would say not to have one.
Talking about dilution, that's probably also like a technical aspect, but wholesalers, given the consolidation, they have certain power when they provide access to their network, where they ask more and more frequently about like these gray goose clauses, where they would say, if the brand is being sold, we're going to get a certain share of the brand. if you make an investment, if you take a position, how do you deal with that? Is that independent of it, or do you use your leverage over the distributor to let them take that go away, or how does that work?
I think it depends on the situation. Sorry, it depends. It depends on the strength of the brand, what the closet looks like. I will say though that shows how incredibly important it is for founders to be very careful about agreements that they enter into early on. I've seen some really fantastic potential opportunities just not be able to materialize because of decisions that had already been made prior to coming to us.
Same answer, yeah.
So can you talk about the pros and cons of taking like a regional approach? So a bunch of small bets, different countries versus like a big bet on a brand that you're taking global?
Yeah, so you're saying what are the pros and cons of the regional approach versus a national or global approach? Look, I would say with any entrepreneurial proposition, we want the entrepreneur to be super focused. And I think the broader you go, our philosophy is deepen before you broaden. The broader you go, particularly early on, that means every minute, every dollar, every second you spend on another country or another state dilutes from building your brand in your home market, or maybe not one market, but your home territory, a group of markets. So we tend to prefer and want the entrepreneur to be super focused. Of course, we are looking for financial return, so it'd be a lie to assume that we're never looking for a brand to go nationally or go even globally. So we look at that, but on a much longer term basis, and we want to make sure they own their backyard first.
And I'll actually take that question and spin it a little bit from a portfolio standpoint. We see a lot of folks who have developed these very robust portfolios with lots of offerings across spirits categories.
Yep.
Again, depending on who your potential investor is, that might be very attractive to a financial investor, maybe less so to a strategic. So really understanding who you're targeting and making sure if it is a strategic, likely the bias will be towards a much tighter portfolio.
Yep.
You guys are doing for the strategics, when you guys are doing your earlier stage deals, what are the non-monetary terms normally? Is there a path to control normally in those deals?
Yeah, so you're saying what are the non-monetary terms in a deal, and is there always a path to purchase? So for us, there is always, I'll answer the second question first, there is always a path to purchase. We want to eventually get 100% of that. Having said that, we're always open to continuing with that entrepreneur for a longer period, whether that's through some kind of earn-out proposition or, representing the brand from a national celebrity type of brand ambassador perspective. We are always open to that, and we think there's value there, of course. The first question about non-financial terms, non-monetary terms. So I'll use an example with Del Maguey Mezcal, which I think is really interesting, and maybe one of our better examples where we put in terms into the agreement that had nothing to do with the financial aspects of the deal, let's say. This is just one example, but we felt, knowing how the corporate structure works, and there's a level of people are rotating jobs every 2 to 5 years. That's how it tends to work, at least at Pernod Ricard. We had a serious concern that all the beauty that Del Maguey had created with their brand could potentially be lost if a new person came in my role or came to run New Brand Ventures. Our head is Jeff Agdern, who's been with the company 18 years. He might move on to another position, and we worried that as somebody else came in, they could change without any malintent, but not understanding kind of the real brand proposition and why it was set up. So we actually put terms into there to protect the culture, to protect kind of the aspect of sustainability, and to protect how they actually give back to the local Zapotec communities. And believe it or not, that actually came completely from our end, not Del Maguey's, but they absolutely loved it and signed on right away. So that's one example. I don't know if you're looking for kind of specific terms you want to ask about, but that's one example where we absolutely try to say this isn't just about finance, this is about creating a partnership, and a partnership that makes sense on both sides. And in order to do that and protect kind of the thing that made the brand successful, of course there have to be measures outside of the typical financial terms that go into it.
Yeah, the one I'd add, I agree with what you just said. The one I'd add is we typically do have a board observer seat as part of the deal. It's just good governance.
On the path to control, what's the situation there for the original investors? How are they being protected, or are they just capped out, basically?
Yeah, I mean, I think they are, it's known to the existing investor base when the investment is made. And then it's clear that, they will be they will have their payout if that day comes.
And it's predetermined, basically, of like, they already know at the time, if it happens at that
There's not a
automatic.
There isn't a predetermined value.
Yeah.
That's determined at the time.
Got it.
But, yeah.
How is that value normally determined? Is it a multiple? Or
Yeah, it's back to the sort of,
initial terms?
it's,
Negotiated then?
so it's negotiated then for us. Again, it does vary by deal, but you look at the typical multiples, you can do a more robust DCF at the time. It's back to it's kind of my original valuation comment.
Okay.
My question is kind of about non-alcoholic more broadly. You saw Distill Ventures or Diageo make a play in the seed lip. I'm not sure if either of your companies have. I know Constellation was an innovator with its Canopy Growth minority investment. So I'd just like to think, the way you put it, Jennifer, where there's the market demand, I think is there, because alcohol growth is kind of, part of it is going down in some areas, but then is the consumer pull there for non-alcoholic? I'd like to hear your thoughts on maybe the future for that in your portfolios.
Sure,
The
yeah.
question was about like non-alcoholic beverages, so.
Yeah.
Yep.
Yeah, you can't open an industry daily in the morning without reading something about non-alc. So it's clearly a trend. Consumers, the better for you movement has been here now for several years and is gaining steam. So it's, we focus 1,000% on the consumer and on what's going on with consumer trends, so you can't ignore it. So it's something we're looking at.
Yeah, same for us. We have not done an investment in the space, as you probably know. We are looking to, but quite honestly, we ask ourselves the question, are we the best? Is our sales force, our commercial side of the business, the best group to actually sell this product? And to be completely honest, we don't know the answer yet, and we're okay with that. We like to recognize our strengths and know where we're weak. So it's something we're constantly exploring. Obviously, it's a trend. I'm not here to say we don't believe in it. We absolutely do. So we try to capitalize on that trend in other ways. So we have low ABV products in our portfolio, the spritz occasion, who isn't targeting that, but through things like that, we try to kind of capitalize on that trend, but have not yet made an investment, and we're not sure how near term that will be, quite frankly.
And as you said, Nick, I mean, with the convergence, right, between function and everything coming together, it could be a Coca-Cola or someone else maybe that would invest in that.
Absolutely. I mean, Coke, for the first time in its history, launched a alcohol product in Japan. Look, the reality is growth is slowing pretty broadly, right? Traditional categories in which most of these companies have been built on are all kind of evolving and changing. The cannabis thing is obviously a layer of complexity on top of that. And when that happens, everything is going to change, right? I mean, it's like I showed the joke about Aleve and brownies and cannabis, but it's true. Like, occasions and functions are going to change, right? And so I basically think you're going to see over the next 5 to 10 years, beverage alc and alc companies basically come together. I think that's probably what's going to end up happening.
All right, and one more question.
Yeah, we kicked off by talking a little bit about the authenticity and storytelling behind some of these craft spirits brands and how that lends itself to some of the salience with consumers. Can you talk a little bit about how you're able to maintain that authenticity and brand equity with brands that you invest in as you start to scale them?
Yeah, I think that's why having really strong DNA from the beginning is so critical. It can't just be this very loose story that can fall apart once it scales. I mean, I think craft is, if done right, and if the DNA is there and it's a very strong proposition with a great quality and a real authentic story, you can scale that. You just have to do it responsibly. You have to make sure that you're not putting it in Walmart if that's not where it belongs, just to get that growth. And so I think you just have to be very, very careful and thoughtful about how you do it and not chase the immediate growth if it's not the right thing for the brand.
Yeah, and I'd say similar answer. I mean, for us, we are looking at, yes, we want the founder, the entrepreneur, to be a major part of the proposition, but the proposition should not live and die by that founder, and we want something that can be scalable and essentially blown up in our system, to be completely honest. So I'm curious. I'd missed, somebody was talking earlier about the discussion yesterday on Ford's, I'd missed that, but I'm curious. I think Ford's is a fantastic brand, fantastic person behind it. I'm curious how it's going to live in their new system going forward, and Simon seemed to be such a critical part of that. Will that be able to be maintained? I don't know. We'll see.
So one of the keys there is pace. What I see covering all the consumer space is it's almost a 99.9% failure rate when you expand too quickly.
Yeah.
So pace and patience, which quite frankly is kind of countervailing to the kind of general theme we see today, where you're seeing things go fast. Pace, that's, I think, the best way to preserve authenticity.
So then to that point, then how do you manage certain like financial expectations of your organizations?
Yeah, I mean, I think that's where the beauty of what we've done with Constellation Ventures is we're part of Constellation, but we are we're separate. And so we view our companies in a different way. We understand what it takes to grow a brand in the right way. And so we have different expectations for those brands. And I think it's just showing, real progress, increased velocity and sustained pull in the markets where you are. And then again, a very strategic thought about where you're going to expand, and then executing that flawlessly.
Yeah, and same for us. I think we look at it as when the brand is in New Brand Ventures versus when it graduates to the larger portfolio. And when it's in New Brand Ventures, even if we're doing a majority investment, we actually want to see day-to-day control. So we'll have certain veto rights that the entrepreneur can't go out and raise money from another strategic or go distribute dividends to themselves without our approval, of course. But aside from that, the day-to-day decision-making is completely left to them, and we want it that way. And then, of course, as it graduates, depending on how the entrepreneur is involved in the brand going forward, we just want to make sure that proposition can be scalable with or without that entrepreneur there.
All right. Thanks so much, guys.
Thanks.
Thank you.